Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we make investing simple. Very important episode with a little bit more urgency than we normally have. We're going to talk a little bit about something that's been on our minds. We've done the previous episodes on this. We're going to, maybe at the risk of repeating ourselves a bit, we're going to hammer this home again in terms of the big one that could be coming. Things are flying high in the market right now. And we're going to talk about how we think that could end abruptly. And so, not to be engaged in fear-mongering or anything like that, but I'm grateful to be joined by Corey Halliday and Noah Davidson. If you're interested in really intense and accelerated education, go now to yourinvestingclass.com. That's yourinvestingclass.com and look for goodies there to take a deep dive and really advance your financial education. With that, I thank my guests for coming. Brief introduction for Noah.
Hi, I'm Noah Davidson. I don't even know what to say about myself half the time. I'm a trader, I'm an investor, I'm a technical analyst, I'm a trade adjuster, and I've had tens of thousands of people go through my classroom over the last 20 plus years, so this is not my first rodeo.
And you got the Cashflow Academy swag on today.
It's hot outside and it's a t-shirt, and I love sporting my Cashflow Academy gear.
Cashflow Academy t-shirt. Corey, brief introduction.
Yeah, so I got started almost 25 years ago now. I went the traditional route of getting licensed, got a Series 7 license, eventually worked my way up the ladder and became a Series 4 option principal, which is basically a risk manager. It's a preparedness position where a lot of what we're going to talk about today is being prepared. It's not about predicting when the bad times are going to be there, but how are you prepared for when the bad times come? And when's the best time to start to prepare and to think about that? Well, probably before the crisis hits, not during. So we're going to talk a little bit about that today.
I'm so grateful because I've been a lifelong student. Since I can remember, I wanted to know about money and wanted to study it even as a kid. My parents were just incredible in that they had an ability to just be they just were very content people. And they taught us about, goodness and truth and honesty and hard work. And they were never really motivated by, huge financial success. And I kind of was. My dad always had.
It skips a generation here.
My dad was always. I respect him for it though, because the guy never cared about what he drove or what people thought about it or everything. I was always ducking down. I was always, materialistic and awful and prideful, and wanted all these material things, I guess. But really, I think the biggest motive I had was freedom, not so much material stuff. I'm not that materialistic. I have a few nice things, but it's really freedom and a sense of security that was high on my list of values. So I've been a student for a long time, and I'm so grateful for my friends here today. We're going to talk about preparing for a crash. What is motivating this tone and a bit of a shift of tone in the podcast, actually, for people that follow us? It really comes from the three of us and the group text that we're on. We share a group text and we talk about the markets, weekly, intermittent jokes and humor and other things that friends do. But the tone of that group text has changed dramatically, recently. And so today we're gonna talk about some of the things that we see. Of course, the biggest risk always is the one you can't see. It's the one you can't see coming that you're always vigilant of. But man, when that's added upon by certain things you feel that you can see coming, I'm not a person that believes in being a Chicken Little and run around my whole life worried and playing defense. Rhetoric is always about a defensive posture. Everyone's after you. Everyone's going to mess with your outcome. And we want to be in a veridical context where the veridical is, what's the truth, what's really happening. So we're going to talk about some facts, and we're going to hop in with this. So with that, Corey, Warren Buffett once famously said that I will tell you how to become rich, close the doors, be greedy when people are fearful, and then begin to be fearful when people are greedy or not fearful. Yeah. And that seems like a very nice chiasmus, and it's very poetic and it's catchy. But I will tell you, the more experience I get, and I'm far from being what is he? He's not an octogenarian. He's 90. Is that a septuagenarian? The closer I get
that's going the other way.
Oh, whatever it is, 90genarian, whatever it is, 90genarian.
Kind of old.
The closer I get to 90, and I'm still a ways away, but the longer I spend in these markets, the more wisdom I see in that, and the more I've seen it play out over and over and over again. Having been through, this feels very, very 1990s to me, late 1990s to me. And I've been through this irrational exuberance before in the midst of issues where people are ignoring them. And it just feels like the things that many perma-bears have been talking about could come to fruition. So talk a little bit about sentiment and what you've been feeling in these markets.
Yeah, so you mentioned a term there, perma-bear, which is some people are just always pessimistic. And that's one of those things where if you just keep calling for a crash, well, eventually you'll be right, but you didn't make any money off of it or really protect yourself, So it's important to kind of create that context of we're all optimists, not pessimists, right? We all own stocks. We bet on the markets going up over the long term. We're very much cheerleaders for the stock market. And I look at my history. I mean, I have been buying stocks for decades now, and I believe in the financial markets. I believe that stocks go up generally. And for many years, I used this term. Because as a teacher, you try to emphasize something, and the best way to do that is to kind of get something that sticks with them. And I would say to my students, I would say the biggest bear or the biggest bubble I see is in those predicting a bubble. And what I wanted to emphasize to them was that there's so many people that are pessimistic and predicting that, a bubble's about to burst. It's here. It's going to happen any moment. That makes it less likely when you have that many pessimists. But I have to say there has been a dramatic shift in the last couple of years, and coming out of COVID really changed some things because I think it set a tone where essentially you're supposed to go through recessions. You're supposed to have economic downturns. And during those periods of time, it's supposed to be a situation where the weaker companies fail and the stronger companies survive, and you get rid of the excess. And that's the way the markets are supposed to behave. But with COVID and with checks being sent out and with the Fed put option and them basically advocating for sending out money and doing all these things, I think it created a lot of zombie companies, and it created this false sense of belief that, well, markets always go up and the Fed's always there to protect you. And so there's an optimism and a belief that there's a safety net that I don't think is truly there. Will the Fed step in and try to make better of bad situations? Yes. Does that mean that stocks cannot go down 30, 40, 50%? Absolutely not. Not only can they, that's what they do in bear market events. So the fact that you have all of these companies that should have failed and that are still out there plugging away, well, what happens to those companies? They have accrued massive amounts of debt. They have an inability really to generate enough earnings to pay off those debts. And so in the next economic downturn, when interest rates have gone up and you have weaker companies that cannot pay their debts, you have a massive cascade of potential bankruptcies and failures across corporations. And the Fed trying to backstop that could be an enormous problem because you may have far more company failures than ever before if we get a bad economic downturn, because the companies that should have failed in the last cycle were not allowed to do so. And that's a big problem for the markets.
I want to echo this in that I have a concern about cash flow. As I talk to friends and other business owners, people in the pharmaceutical industry, people in the financial industry, people in almost across the board, even some in AI and tech, I've seen people laying off. I've seen their revenues going down, and when that happens, it's very simple fundamental analysis. Even in a house can understand this. You have expenses. That is the the millstone around your neck. The expenses never goes away. You can try to reduce them, but you cannot eliminate them. Churches have expenses, schools have expenses, people have expenses, corporations have expenses, governments have expenses. It costs money to stay alive and keep stuff running. And there's only three sources to feed the expense, the hunger of the expense monster: new money, old money, or borrowed money. New money comes from the income of cash flow coming in, revenues, sales coming in, taxes coming in, paychecks coming into a household, whatever it might be. And when that is gone, then you move to old money, which is, okay, well, how much do we have? Are we going to dip into our assets and sell the gold we had hidden under the mattress, or the cash that was stuffed in the bottom of the cookie jar, or wherever people hide it? And then you go to borrowed money, where that's a limited resource based on your credit. And as I look at the downward trend in revenues for many companies, not all, and it's deceptive because you have a few big winners who are still cleaning house, Amazon and Nvidia and Apple, who are still cleaning house. But there are sectors that are underneath that are struggling mightily,
with hundreds of companies.
And many companies. And those companies have lots of employees. Those companies are cutting hours. And just the feeling I have within my own circle of influence, I get a text, hey, so-and-so, I know someone who's getting laid off. Are you guys hiring, Andy? Or a family member might text and say, hey, I'm being downsized out of my job. Could you network for me a little bit? A text from a colleague, hey, I've reduced my staff by half. I don't know what the big numbers always say about employment. It ticks down, it ticks up. Those numbers don't mean as much to me because they manipulate them so much. But when it starts to invade what you can observe with boots on the ground, that feels very 2006-ish, very 1999-ish. And maybe, Noah, you were talking beforehand about some of the sectors you see. This is a big deal and a big underlying red flag that I think you ought to articulate.
A lot of the discretionary spending companies out there, where people tend to spend money less when they're on tighter budgets, are getting kind of beat up a little bit in the market. The market's at these all-time highs, and I'm watching the food and restaurants just getting decimated.
Yeah.
And it's one thing to watch it. It's another thing to kind of realize, hey, this is an undertow. It's a clear sign that people no longer think those things that used to be considered kind of cheap and commonplace are now considered kind of a luxury. And watching big juggernaut type companies, McDonald's, Starbucks, Disney, these companies that are in kind of discretionary spending areas of the market, they're not having a good go of it.
Nike is down.
Nike's
massive.
down. Lululemon's down. I mean, there's a bunch of them that are down.
My kids went to an amusement park this weekend. There weren't any lines on a weekend. On a Saturday wild. They went. On a Saturday, and they're going on roller coaster after roller coaster at a major move. It's a Saturday in the summer when school's out, and nobody was there.
Yeah, that's wild.
That's a big deal. So discretionary is a big deal. Inflation accelerates that expense column. It puts a rocket booster on the money going out at the grocery store and other places. And it's of great concern. We're going to talk more about problems when we come back from this break. But more importantly, we're going to share with you some of the things we're doing solution-wise. It's one thing to predict and to say, hey, we feel like we could be getting close to a pretty decent pullback. But it's another thing to say, what are you going to do about it?
Yeah.
So when we come back from break, we're going to talk a little bit about those things. And you can tell my tone's pretty serious right now. And so hopefully we can bring our jovial, we'll need Noah to crack a joke or something. I'll tell you, he said some pretty awful things before we went on the air.
Cameras were off.
You always count on Noah to just say some really things that cannot be broadcast. He had it coming.
Now I'm already blushing.
That's all I'm going to say.
All
He
right.
had it coming.
He had it coming.
Oh, man. So when we come back from commercial break, we'll talk about solutions.
Responsive to questions, they're very detailed in their training. You can start from no investing experience whatsoever and get educated and be able to make a nice retirement for yourself or even a living. It's an amazing educational system, and I would highly recommend it. The one thing that will get you more confident in investing is your education, your competency, and if you can get to that point, you can do anything.
Okay, we're back. Cashflow Academy podcast. I'm your host, Andy Tanner. We're going to make investing simple as we always do. We've been talking about the sentiment. We've been talking about sectors that are struggling. We've been talking about the fundamentals, the amount of debt, and we're going to shift into some solutions here in a minute. But another thing that's really concerning to me is that what is different about the Fed right now than, say, 2000 to 9/11, 08, 09 with subprime meltdown. The big difference is they don't quite have the bullets in their magazine. They don't quite have the tools at their disposal, or at least not effective. In other words, in the past we've had this thing, the Bernanke put, the Yellen put, the Powell put, and really the Fed put, which is really jargon for saying, hey, if things get bad, they'll just inject liquidity and solve the problem with printing money. What we have now seen after, and then COVID hits and they just went to that well again, but this time there was finally a major fallout where they said, oh, we have inflation. Well, it's probably transitory. Now it's sticky inflation. Now we're having disinflation, which means instead of going like this, it's going like this.
Yeah.
It's still going up further than they want. Prices are still getting higher. And the prices, we're not having depression. We're still having inflation. It's just disinflation where it's not growing as fast. This is killing people. So if you talk about that and comment, Corey, on, I don't know that the Fed has the same confidence in just injecting liquidity in to provide, helicopter money to solve these problems. I think if so, it gets exacerbated by inflation and no matter what they give. And we've seen countries get into this cycle where, okay, great, more money, but with the inflation, it just costs them more and therefore ineffective.
Yeah, and the Fed's two mandates are full employment and price stability. And so since employment is not an issue, but price stability was a huge issue, I mean, you had double-digit, essentially, inflation, and that's a major problem. When inflation's running at 10%, it's essentially, think about what that does to the average person, where you look at average incomes and then their expenses go up by that amount. Most people do not have enough for a safety net. They don't have anything in savings. I mean, that's the world we live in at this point in time. So it's not about the people that are in stocks. The people that are in stocks, for the most part, are okay. But the majority of individuals are not invested in assets. They're living paycheck to paycheck. And so when you have that massive inflation, it creates an even wider wealth gap. And that's a huge problem, I think, in the world, is this wealth gap. Because if you don't have people willing or able to basically make their payments and to continue to provide work and services and so on, it basically is kind of this, I would call it a domino effect, where now all of a sudden the Fed says, well, we have to allow some of this pain to come through because we can't just throw money at the problem. If we throw money at the problem, inflation spikes, and then people can't pay all these things, and it becomes a bigger and bigger problem for them. So I think at this point, they have to allow for some of the failures. And that's both good and bad news. The good news is that's how cycles are supposed to work. You're supposed to have some economic downturns. When you study economics, there's these cycles that you go through, and part of those cycles is going through a little recession. The Fed, I think, fell in love with this whole idea of modern monetary theory where they could get away with anything. And they thought, well, inflation just never seems to arrive. And that just wasn't true.
Hey, can we just highlight the point that they were wrong?
Yeah.
There's a sense that, we're three guys sitting here in the studio, giving our opinion. Well, what authority do we have and what brilliance do we have to match, the incredible omniscience of the Federal Reserve. Well, I'll tell you, they were wrong.
Yeah.
And in a big way, they were wrong.
And
Well,
they've even admitted as much.
You were saying they allow for down cycles. We haven't really even seen down days in the last several months.
Yeah.
And so the market's just ripe. It's way overdue. And again, I don't know when things happen, but it's not hard to recognize that irrational exuberance the market's going through right now.
Buffett's letter was telling, because Warren Buffett is an ultimate optimist. There's no one that believes in American business more than that guy, and no one that's bet on it bigger than that guy. But he has set aside cash and blatantly said that there's a big one coming. And that's not like a perma bear going around, the sky's falling, the sky's falling. That is Paul Revere saying, the British are coming. Get your gun, defend your family.
I mean, if there's anyone that's a cheerleader for stocks, it's Warren Buffett.
Yeah.
So when he's pessimistic and when he has record levels of cash and when he says, hey, we know that there's going to be some problems, and when he's selling a big percentage of his Apple stake, which he hasn't done before. I mean, all of these things.
Most successful stock he's ever had, by the way.
Yeah, he's made more. Berkshire shareholders have made more off of that than any other stock they've ever owned. But you look at it from the standpoint of, again, it comes back to the Fed just cannot do. If you make the same mistake over and over again, that's a bigger problem. And the Fed knows that inflation got away from them. They've admitted as much. They argued it was transitory, and then it wasn't. And they had to ratchet up interest rates. But are they going to be able to come in guns blazing and printing money and papering over all the problems the next time? I think inflation, and rightfully so, it scared them enough to say, hey, we can't risk this, because an economic downturn where you go through these cycles and you have a recession, it's not fun, but it's livable, it's manageable. But you can't have a banana republic. You can't lose the US dollar. If the US dollar, basically, if inflation starts to go hyper and you lose the trust and confidence in the US dollar, you're cooked. And the entire world is cooked at that point. So they know that it's a far greater risk to lose the US dollar than to have an economic downturn, than to have companies that go under, than to have unemployment. So what's the trade-off? What's the risk to reward? They can't risk inflation getting away from them.
Well, and the dollar is no longer on the sound footing of the petrodollar that it has been for the last 50 some odd years. That contract has expired. And unless the Saudis decide they want to re-up with that, that is that's kind of been the secret weapon of the U.S. is the ability to export their inflation, because it was pegged to the price of oil. And so it created an artificial demand for the dollar. You go back 20 years, 90% of the global oil transactions occurred with the U.S. dollar.
Yeah.
We're well under 50% now, and there's a competing interest out there, a very strong competing interest that's doing a pretty good job of road and beltway initiatives, getting more and more people off of the central Western banking system.
As educators, we face a very difficult challenge as educators, because the nature, the human nature, the framework in which we are forced to exist and work is one of sound bites, quick fixes, TikTok videos. Notice that TikToks are shorter, tweets are unlimited number of characters. There is a premium on quick, short bites of stuff that rob us from really deep dives to gain more than just a superficial understanding of topics. So, our marketing department will say, Andy, just give me 5 quick bullet points to say, and it's just like, this is, it's like when I was, it's like when I was on that flight with that heart surgeon, and he spent 4 hours telling me about all his education, heart surgery, and then, on descending, he'll say, give me a couple of stock tips that I can go, invest with. I well, give me a couple of tips to replace my bicuspid valve with a butter knife tonight. So the challenge we have is of time. And, when we talk about, we don't like our podcast to be an infomercial. We like it to be informative with dialogue that helps people and is food for thought and gives insight. Our products that we create at the Cashflow Academy, the number one thing is value, to say, hey, if someone invests in themselves, that they feel they got great value and that they're going to have a return for what that knowledge is. And as Benjamin Franklin said, the investment in knowledge, the interest is just the best. So, what bothered me as an educator was the ability to articulate the depth and breadth of the debt, of the sectors, of the unemployment, of the bond illiquidity, of the petrodollar, of the Fed, of just this, of the sentiment. All of these things and more take hours and even years to fully appreciate and understand. As far as preparing for it, it's even worse, because to capitalize on a catastrophic, or well, not catastrophic, that sounds like the death of everything, a major market move that is devastating to a 401k. And I know you care a lot about this, as I do, guys, that we know so many people are depending on that 401k to cross the finish line over the next 10 years. 75 million baby boomers are counting on it. This couldn't come at a worse time for them. They can't have a decade of nothing like we had in the NASDAQ from 2000 to 2010. They certainly can't have a 30 years of nothing like Japan has seen.
Yeah.
They can't afford to have it happen. And here's the damnable misery of being an educator in this environment, is that you look at 9/11, there was a complete breakdown in communication between first responding agencies because they were not coordinated, because they'd never drilled on anything of that magnitude before. Like there was nothing that, the New Orleans, the flood that came and breached the levees, there was just no protocols for this, right? Yeah. It was not something they had dealt with. And so let's say that, my brother's a police officer and they drill for as many scenarios as they can, but a 50% drop or a 60% drop in markets isn't something that happens often enough to practice it every day. Yeah. In other words, as an educator, I can help people get a dividend, write some options, we can do some spread trades, we can get a very consistent cash flow coming, and we can practice that on paper and get really good at it for a month or so and then go to work and get an income. That's not a challenge. In fact, it's a very easy challenge to address and win. But to protect, survive, and especially thrive in something that's happened 4 times in my life.
Well, I mean, more than 50%, you get like 4 times in the last 100 years.
Yeah.
Is where it's gone past like 50, 60%. Everything else has been above 50%.
So to prepare someone for that and to drill it and to practice it, and I just remember COVID so vividly, and it was visceral for me because we develop a kinship and relationship with the most serious students we have. Those who, there's the podcast listeners, but then there's the people who actually engage in weekly courses with us and they're serious about financial education. I'm looking at all these guys and, I've taught it, but have we drilled it? Are they really ready? And our system, I felt the weight and the responsibility. We have in those days, we had about 10,000 spots in our online teaching system gone. Yeah. And so I've been through this as an educator as well, and the burden of leadership and saying, this is how I'm going to navigate this. You got to do what you want, but this is how I'm going to. And not having, I just wish I'd have had 6 months of drill with those guys first. So,
well, I remember that time, and I remember the weight that we felt for these individuals because we feel responsible for our students. We feel responsible to make sure that they're prepared. It's sort of like a parent and children. Have I taught them enough to go about and do the things that they need to do in life?
Can they make
it? In the financial world, we feel responsible for these students. Have we taught them enough? Have we shown them enough how to protect themselves, how to buy protective puts, how to do these things for their 401k so they don't get decimated?
They haven't drilled it.
Yeah, and so that practice, that technique, that education where it's a deeper dive, it's not superficial. It's, hey, you really need to have done these things and learn these things and practice these things and spent some hours dedicated to it to really understand it so that when that time comes, you're prepared. Because the idea that you'll be prepared and be able to learn enough in a short amount of time while it's happening, it would be overwhelming. So this is something where it would sort of be like, putting in a kid that's brand new to your basketball team and saying, hey, we're running these plays, go get in there. And he's like, well, I've never practiced these. I have no idea where I'm supposed to move.
Here's a calculus test for someone who doesn't know their number line yet.
Yeah, good luck. And so, I remember there was an individual, I think he was in Italy.
He was.
And he said something to the effect
We're locked down.
We're locked down, but we're here with you in spirit. And I just remember we got emotional in that meeting.
What he said, he says, we're just so grateful that we're here to listen to you. And when he said that, the burden of leadership and the burden of teaching the proper things, I mean, I was just crushing, And it was wonderful because we have been through these things, and I did feel prepared for that. I almost felt emotional because I thought all this time had prepared me for this particular
moment
lesson right here. So anyway, the point of this is of solution-wise is Corey and Noah and I text, and so we're talking about our own personal plans of what we're doing personally to prepare. And how we're getting things set up, and we're looking at different specific levels of where things might go and certain ways to leg in. And the ideal scenario for me, what I've been talking about, is the idea of I'm not interested in selling shares because I want to own stocks. I don't want capital gains taxes. I don't want to lose a bunch of those capital gain profits by having to sell and pay a tax. There's a lot of reasons.
And then if you go into cash is terrible because we know they're just printing more and more money. So you never want to just
depreciating asset.
Right? So you never want to just be sitting there with massive amounts of cash if you can be doing something better.
But if you can hedge properly, you get your have a cake and eat it too, where you can have an insurance policy, let's say, just explode in value, keep your assets as they go down in value. But now you have the perfect scenario because you have all the same number of shares you always had, and when it recovers, you'll benefit. We believe in the optimism of recovery. We don't think the world will end, but we don't have to worry about that time because we get to take that insurance policy, cash it in, and buy when everything's on sale. To me, that is the perfect play for these times, is knowing how to hedge properly. A good example in COVID was Exxon, as I was buying it anyway. And when I saw this happen, I bought some hedge, I bought some protected puts, let my Exxon drop, exploded the value of that insurance policy, kept the Exxon. Now the Exxon's doubled in price, but I took that windfall and invested in more stocks at the low prices. It's about as perfect as you can play it. So we actually get excited. I almost said stimulated.
Well, we might get that too.
I don't think that we can handle any more stimulus package.
We might have stimulus.
Yeah, the stimulus package.
But we get excited about this. But I thought, how ready are our listeners? So we're gonna do something we've never done. It's gonna be an event. We don't even know what its name is. And if you have an interest in it, it's not going to be a free event. It's going to be for people who are serious and want to invest in their education. But if you're not on our mailing list, and I don't know how to get on our mailing list, I guess you go to our website.
I think there's a link.
Go to
something like that.
You can go to
yourinvestingclass.com.
That'll get you on our mailing list. You can go there and just start getting in contact with us, because we're going to be making an announcement in the next couple of weeks. Is we're building an event that's going to be 4 days in a row. And I can already hear people saying 4 days in a row. It's kind of like when I coached my basketball team of these third graders, is when my oldest son turned third grade, he wasn't good enough to play, so I had to be the coach or he wouldn't have gotten picked. So I show up to tryouts and no one was willing to coach. Like the school had a tryout for their Bantam program, and they were hoping that they'd also have a volunteer coach. So I volunteered like an idiot, and I rented a hotel ballroom, a small ballroom, not a big one, and I got my projector and my flip chart out, and all the parents and kids that I picked, I said, okay, we're going to run this full freaking bore. I'm going to provide a hour and a half practice for your son at 3 p.m. after school program, 5 days a week, and on an optional day on Saturdays. We're going to film every game we have, just like a college would. I'm going to break down your son's game. And the parents reacted in one of two ways. The first set of parents, about a third of them said, really? Third grade? Really?
Yeah.
You're going to practice every day for third grade? Really? You're going to film like these guys in college and they're in the freaking third grade? Are you serious? And then 2/3 of the parents said, really? You're going to provide my son with a practice every day in the third grade? You'll really do that? You're going to provide him with a film and break it down, even though he's only in third? Really? You'll do that from us? And there was an attitude of that.
Yeah.
And I can hear both of that all the time where I say, look, we're going to dedicate, I don't know how long it'll be each evening. I don't even know as long as it takes. We'll start in the evening. We'll do it live. And someone's going to say, really, I have to adjust my blah, blah, blah. Fine. Or someone going, really, you'll give us 4 days live in a row. We're not going to do this as a recorded event. We're going to do this as a live event so we can kind of see the chat as best we can. We're going to charge a lot of money for it to bring in fewer people probably. We hope we have a lot. But what we're going to do is we're going to talk about how, like, if you have over $1 million, how do you protect that in something like this? And what practice and what do you do? And what are the tools and what are the levels and what are the specifics? And the only thing I can say is it might be above a lot of people's pay grade. And that I worry about too, is if you haven't taken ultimate options, we're going to be using those high-end skills. If you haven't taken, the adjustment repair playbook, those are high-end skills that we will be employing. If you haven't spent 2 years in the weekly mentor club, we're going to be doing those things. So catch up, do the best you can. Some people, it will be an experience where they're just holding on, and it'll be incredible because they'll say, I now know what I don't know.
Yeah.
For others, it'll be incredible to say, I'm starting to see how specifically I can apply in a better way. But I do this partially because it's a great opportunity as a company to create a course that is that has the price to value ratio on this is off the charts. So that's always a great opportunity business-wise when you have information that is so much more valuable than what you charge for it. That's always a winner. But more importantly, without getting too emotional about it, on a personal level, having done, how long we've been in the Cashflow Academy, how many years have we been doing this, to make sure that no one can say, Andy, you didn't tell us and you didn't help us enough. Yeah. We're not doing a COVID thing again where people don't know what to do and they're coming to brush up because it hasn't been on their front burner. So, I don't know when this is going to happen. I do believe that it will. Hopefully it's long enough where people can study and learn and practice a lot more. But we don't have time to wait for that because it could come sooner than later. So in the next couple of weeks, watch for announcements. We're going to do 4 days or 4 nights we've committed to, where if you have $1 million, you want to know how to protect it or how we would do it anyway. And if you don't have $1 million, how do you protect that smaller amount? If you don't have a lot of money at all, but you want to capitalize, because there's always big opportunities in a transfer of wealth that large. So for the guy that has a lot, the guy that has a little, and the guy that has almost zero, we'll do a night. The guy will do a night. The guy who has a 401k and doesn't really have a lot of freedom to manipulate that, what do you do with that? I mean, these are the questions that we're going to...
Well, we understand that there's people from all different walks of life and people that have different amounts of money. And we want to hit all of those key points, like you said, because we want protective positions if you have a lot of assets. We want for those that are just looking to basically protect some of their assets but still grow their assets during that downturn. And then the person that's speculating and says, well, how can I capture this downturn? And that might be the biggest opportunity of all, is really how do you take advantage of these market downturns? Because if you look at it from a trading perspective, the trader, and I know Noah's a big trader, you can make more money in a bear market than you can in a bull market, and faster, and a lot faster.
Kind of hard not to want to be a perma bear all the time, and it's
from a trading perspective.
Why are you smiling maniacally at the thought of a crash?
He's so happy.
It's an involuntary
He's
response.
Stimulated.
It's an involuntary response.
My goodness.
Well, I've been through a bear market before, and I've experienced that downward turn. It's sharp, it's fast, and if I were to make a bold prediction, I think what's coming down the pipeline is going to be the single largest transfer of wealth in the history of the world. And I don't say that lightly. The conditions are ripe for that downturn, and it's going to transfer wealth from those who don't know what they're doing into the pockets of the people who
Everybody's going to tell us we're crazy.
know what they're doing.
AI is going to prop it up. AI has volatility coming, just like the internet did, just like Bitcoin
AI is
did.
going to figure out that shorting the market's the way to make all the money. That's what AI is going to do.
Yeah, well, speaking of shorting, you bring up a good point there where in the history of the stock market, there's always been a two-sided market. You got longs and you got shorts. And the amount of short-only funds, hedge funds and so on, that have shut down in the last decade has been astronomical.
Yep.
We basically have gone to a one-sided market where everyone says, why would I bet against the market? The Fed always protects. It always props it up. And the Fed can't do that anymore. It really cannot. It runs too high of a risk. And so now you're running out of the Fed put at the same time that none of these short funds are available. The amount of potential downturn, the shorts, they have an ability to basically create less downside because as markets go down, they cover their shorts.
Right.
And so they offer some added boost to the market. They make it so it's more orderly as you go down. Without those shorts to cover, and if the buying pressure evaporates, I mean, you can have flash crashes, you can have all sorts of things coming down the pipe, and we've seen glimpses of it. But I tend to agree that there's something big coming, and I don't know how soon, but we'll know that there are certain levels and certain things in the VIX and certain telltale signs that we'll be teaching in this class to know, okay, if you check this box, and this box, we've got a major problem technically. If you check this box, and this box, we've got a major problem fundamentally. And we'll be teaching those points. And when we check those boxes, it's going to be a problem for the markets.
The value proposition is something I'm excited about because the amount of money to be lost and made is very, very large in relation to the tuition that we'll charge for this. So I don't know what we're going to call it. We'll have the marketing team come up with a good name for it, but we're going to be there, and basically we're going to. I talked to Noah and Corey, and I just felt very strongly that the things that we're talking about internally between the three of us in great detail, even if it's above people's pay grade for education right now, we'd be remiss if we didn't walk them through that. So at least they can, even if they're new, at least you'll know what you don't know and know what to.
Well, I could make some pretty safe guarantees. I'm pretty sure we can teach the basic concepts, no problem. Understanding what a protective put is, not a problem to learn.
But more importantly, the amount, where, the strike, what level, what technical breaches, the ratios of protection, those specifics are really the value add in beyond just the general concepts. Wouldn't you say you're confident in that as well?
Yeah.
Not a problem. We're pretty good teachers. We've been at it for a while.
Yeah.
Noah's going to bring the humor. Somehow we're going to laugh our way through this. It's very exciting to do. So with that, hope you enjoyed this bit of an infomercial. What are we going to do about it? Simple. We're going to practice. We're going to prepare. We're going to hedge. We're going to have protective puts. We're going to use futures,
collars,
all that
sorts
stuff.
of things.
We're going to learn about delta neutrality, how to go. The best thing
beta
in the world
weighting
is to go delta neutral. Let the delta neutral. Let the portfolio fall. Let the insurance just go wang. So your net is the same, and then you're left with all the shares you start with, and just a freaking wheelbarrow full of cash.
To buy more assets at massive discounts.
And that's the play. That's delta neutral. And the feeling of safety when you're delta neutral during all the chaos is an incredible emotional, it's stability emotionally when you can get delta neutral and understand how that beta weighting works. So there's a little infomercial in the second half. Now do the short commercial. Go to yourinvestingclass.com. If you haven't been there yet, get started right now so you can be further along. And then when an opportunity for higher level education comes, you're better prepared for it, for sure. So that's our opinion. Be ready. Be ready. And I thank Corey, I thank Noah, and most of all, we send our appreciation for you guys for investing some time in yourselves to be aware and to not put your head in the sand and to become an investor that has cash flow throughout the whole thing. That's another important one. Maintain the cash flow throughout the whole freaking process. Capital, your net worth can fluctuate, but your cash flow has got to stay consistent. Yeah. With that, we again thank you for listening. We'll see you next time.